Welcome to Westmount Wealth's Meet the Manager series, where we interview asset managers and look under the hood, asking questions you want and need to know. Good morning, and welcome to another installment of our popular Meet the Manager series. My name is Lorenzo Pederzani.
And I'm Matthew Evans, and we are the two portfolio managers on the Westmount funds.
Today, we're here to showcase one of the interesting investments in our Westmount Real Asset Fund, and we're happy to have Sanjil Shah, who's the managing partner of the Alignvest Student Housing REIT, to tell us a little bit about the fund and the strategy. Sanjil, welcome.
Thanks for having me, Lorenzo and Matt.
So could you provide our viewers with a bit of an understanding of what exactly the strategy is and why somebody might want to invest in student housing in Canada?
Sure, happy to do that. So we started in 2018 as the first pure play student housing aggregator or consolidator in the sector. And really it was a idea that came out of what we were seeing happening in other parts of the world, namely the US and the UK markets. And we realized there was an opportunity to build something of scale and significance in Canada. To date, we have acquired 12 properties in 6 different markets with just over 5,200 beds.
Excellent. Could you talk a little bit about the value add in the strategy? So obviously, purchasing and holding real estate, is something that a lot of our viewers would be familiar with, but what are you doing to actually extract more value for investors as part of your strategy?
Yeah, that's a great question. So what makes student housing really unique is it's highly operationally intensive. And that's for a couple of reasons. First and foremost, our tenants are students, right? Students, we all know the rumors or the myths around students, how they beat up the properties, but they also have very high turnover. Students are transitory, so on max we have 2 to 3 year tenancies. We have about 50% average annual turnover. What's really complicated and what makes this really a tough business to operate is all of the turnover happens on the exact same day every year, September 1. Right, so from an operational intensity perspective, we have to gear up all of our leasing and pre-leasing to make sure that every one of our beds is full by September 1 when the students move in. Because if a bed is vacant on September 1, that means students have found somewhere else to live, and our bed's going to be vacant for the next 12 months. So that's really, the value-added perspective is how we manage these properties. It's not a passive investment by any stretch. It's all about optimizing the leasing cadence, the rental rate growth, and the student experience.
Is this just a collection of properties, or is there a business model beyond that you're developing here?
Yeah, it's really, so operational real estate is really much more about the business versus the real estate. The real estate is going to hold its value, right? Real estate is an asset class that performs strongly through the ups and downs of the market, irrespective of the cycle. But in student housing, because we have that high turnover, we're able to keep the rents moving in check, in line with inflation, especially with what we've seen over the last year with inflation, hovering at between 6 and 8% across Canada on a month-over-month basis. Our rents are growing at a faster clip. In fact, for this year, for September 2023, we're targeting to have an 8% average net rental rate increase. And so that gives us that leg up where we don't have that substantial gap to market like traditional multifamily apartment building owners have. In an inflationary environment, families are less likely to move out of their buildings or their units, and then the landlord is stuck with a growing gap to market. We don't have that perpetual gap or building gap. We catch up in 1 to 2 years as the students turn over.
So we've had a tremendous run in real estate performance in Canada over the last few years, and that's really been a function of an interest rate environment where interest rates have continuously decreased. We're now in an environment where rates have increased dramatically. How would this strategy perform in an environment like that?
Yeah, it's a great question. So, I think this goes back to the operational intensity and our ability to keep raising rents, right? So when you can keep raising rents ahead of inflation and ahead of the rising interest rate environment, then there's always a positive spread, and you're able to keep your leverage cash flows in line with expectations. However, the reality is it is tougher to do acquisitions in this environment, right? There's no doubt about it. And we have to be much more thoughtful, much more strategic, much more targeted. So I would say, the honest truth is 2 years ago, we were okay buying any asset that came our ways because we knew that the money was effectively free. Whereas today, we're being much more disciplined, targeted. We're looking for more established universities. We call them Tier 1 universities with 10,000 plus students, growing enrollment, large international student presence. And then the flip side is we're looking at the supply characteristics, right? We don't want to go to a market where there are lots of beds available for students. So we're looking for markets where there's really nowhere else for the students to live. And then the final piece we look at is displacement risk. When we do look at a potential target, we want to make sure that our building cannot be displaced by the shiny new tower that's going to be built between us and campus. At the end of the day, we all know that students, like most of us, are lazy. They don't want to walk far, right? So if they have to walk more than 5 to 10 minutes, they're just not going to want to live in our building. And if somebody builds a new tower between us and campus, then we become the old building that nobody wants to live at. So we do a lot more due diligence, a lot more market research to make sure that our business plan can sustain itself and keep growing and delivering strong results.
Can you touch a little bit on, you mentioned Tier 1 universities as opposed to perhaps colleges. What's the thinking behind that?
Yeah, it's a good question. So there's a couple of things. First of all, the program length, right? Universities typically have 4 to 5 year programs. Colleges have 2 to 3 year programs. The tenant profile, and what I mean by that is in university, the students, we get parental guarantees on our leases, right, to protect against bad debts. Colleges, the students, unfortunately, they're less likely to be able to get strong credit or protection from the parents. Many of them are paying their own tuition their own way, so there's a lot more default risk. And then the turnover risk, right? And what we've seen happen is in colleges, the students who enroll in colleges are more likely to give up their studies or give up their education if they land a job, right? If they get something in the trades or something that they like, then they'll just walk away from college. Whereas in university, the students are more likely to stay through the duration of their education. So for all of those reasons, we prefer universities. It's not to say that we would exclude colleges, but the bar is much higher. It's got to be a college where we know there's a real demand that's driving the need for student housing.
So we've had rising interest rates. We're looking at a teetering economy. We may be going into a recession in Canada. So how does an asset class like student housing perform when things start to slow down?
Yeah, it's a good question. So from an operational point of view, and I've got to separate this because there's the operational and then the growth story part of it. From an operational point of view, when we started this business back in 2018, we looked at the back-tested data and specifically to what happened in 2008, right? And there was really no data in Canada, but Green Street puts out a lot of data around the US sector. And what we found was quite striking. In 2008, student housing was one of the best performing sectors in real estate. And when you scratch the surface and start looking at it, why is that? It's pretty obvious. What happens in a downturn? People lose their jobs. They got to go back to school. Kids are graduating from university. They can't get a job. What do? They stay in school, both of which drives demand for student housing. So from an operational perspective, I think we feel quite confident that we could weather the storm. Look, we've weathered COVID, we've weathered rising inflation, and we know that in an economic downturn, we'll do okay. So I think we've been battle tested over the last 5 years through almost any kind of circumstance or situation that you put in front of us. The other part of that, the other part is much more challenging. The growth part of it becomes harder and harder to execute, right? If we head into a slowdown and interest rates continue to be high, then it becomes a problem that's just difficult to navigate, and for a couple of reasons. First of all, interest rates are what they are, so we have to make sure that we can do accretive acquisitions. But the challenge, of course, is that vendors never want to face reality and accept that their building is worth less. And so it takes time for vendors to realize that, and by the time they realize it, sometimes it's too late, right? So we have to be patient. We may not be able to transact if the economy continues to go south, but that's okay. We just have to be patient. We have a really good portfolio that we've built over the last 4.5 years. We're proud of it, and we believe there's lots of upside within our portfolio to keep growing organically.
So we always like to end off with one question, which is tell us how the fund has performed. Could you give us the historical performance data?
Yeah, for sure. So we launched in June 2018, so 4.5 years of performance. Our annual rate of return has been just over 10.5%. This year, we're tracking for the first 2 months of the year at just over 2%. I should clarify that our return is made up of just about half from distribution. We pay out a 4.9, about 5% distribution. It's a tax-efficient return of capital, and then the remainder is all from the growth in the value of the portfolio. And we believe we're going to continue to achieve similar, if not better, performance over the duration of our business.
And two things to clarify. That return figure you gave us is an annualized compounded rate of return?
That's correct.
And that's as of December 31st of 2022?
It's as of Feb 28th.
Sanjil, thank you so much for joining us today and for sharing the Alignvest Student Housing REIT with us. We hope you enjoyed today's segment. If you'd like some more information about Alignvest or the Westmount Real Asset Fund, please feel free to reach out to us. We look forward to seeing you on the next installment of Meet the Manager. Have a good day. So we just wanted to provide a little bit more context for our Westmount Wealth clients as to why we feel student housing is an important asset class that we want our clients invested in. First off, there is a supply shortage in the student housing market in Canada, especially relative to other developed markets. Secondly, demand is high and growing. Post-secondary enrollment in Canada has been growing at a very strong rate. Thirdly, we've seen that both in 2008 and at other market downturns that it tends to be a very recession-proof asset class, with university enrollments increasing during market downturns. And lastly, we feel that ultimately it's a very strong diversifier for our clients, and as a real estate asset class behaves different to some of the other asset classes we invest in, such as industrial or multifamily or office or retail. So ultimately, we're trying to spread a client's wealth out over a number of different high-quality asset classes, and we feel that student housing is an excellent complement as part of your portfolio. If you have any other questions, feel free to reach out. See you next time.